Hi, this is Ian Coleman from Signal Centre and welcome to this week's video analysis for the FX majors and the dollar index going into the week 8th of July 2019. It is Sunday. We do a lot of our work on a Sunday looking at chart formations, looking at our bespoke support and resistance levels and basically trying to decipher what's going on in the FX majors and sometimes some of the crosses. So we're going to start off with the dollar index. Again, we're going to break down some time frames. I look at Ishimoku cloud, I look at DMARC indicators, I look at Marubozu levels, I look at chart formations. I'm going to explain what all of these different technical tools are as we break down through these different currency pairs. So firstly, I'm going to start off with the dollar index. Like I said, I'm going to break down through the time frames, and this is the monthly chart. We've seen a move to the low side from levels close to an Ishimoku cloud top that was located at 98.40, and we saw a high trade of 98.37. Now, we've been talking about this time frame and this chart formation for quite some time. Last week we explained that it was quite important where we got the weekly close. So we had this wedge formation breakout to the downside. We had a doji style candle which highlights indecision, and then we pushed to the upside. Now we had a reverse trendline resistance, so that's the level where we broke out of this wedge formation, and we've retested at 96.72. A move above, or a close above 96.72 basically negates that wedge formation, so it's now regarded as a false breakout. So we need to reanalyze the dollar index. This is the daily chart. So although we're still bearish on the dollar index, and if we just quickly move back to that weekly chart, and I'll explain why. We've got 5 waves to the downside, and then what looks like a complex correction as far as Elliott wave is concerned to the upside. We've got a 61.8% fib level at 97.86, and that's still held. So a technical bias is still to the downside. When we look to the daily chart, here we posted a double top formation that was confirmed with a break of this low. However, this dip has been bought into quite aggressively. Now, we could be forming a bearish head and shoulders here. So this area being the left shoulder, the resistance level, this being the head, this potentially being the neckline, and then moving up to possibly form a right shoulder. Now, if we go to a shorter time frame, you've got to remember this is sort of for intraday and sort of midweek analysis. This last move up in the dollar can be counted in 5 waves. So wave 1, wave 2, 3 and 4, and then up in 5. And we can see that we've stalled near this 261.8% extension level quite late on Friday. So at the moment, we're not looking at selling into rallies in the dollar index. We are looking at buying into dips probably just for this formation to possibly complete. So this being the first wave to the upside, and then possibly a move lower and then a move up to get towards this resistance level. So basically what we're saying is the intraday bias on a lot of the dollar-based currency pairs, I think it's going to be quite mixed, quite volatile this week. We're going to see dip buying, rally selling. So we've really got to concentrate on our chart formations, where our bespoke support and resistance levels are. And I think, to be honest, it's a good opportunity to look maybe outside the box a little bit, look at the crosses. Euro sterling's offering quite a decent setup, I believe. Euro yen not so good, but then if we look at Aussie yen, and I'm also going to look at another euro cross, there's some quite decent opportunities moving away from the dollar index this week. So let's break down the time frames for the other FX majors. And this is obviously euro dollar. So opposite of what we've seen in the dollar index, we've got 5 waves, Elliott waves to the upside, then this complex correction lower. We've got a 61.8% fib at 111.80. We've seen some buying interest around there. But if we actually look to this measuring tool here, we can see that we've had pretty mixed and volatile trading now for 33 weeks in the major currency pair, and that's seen a lot of chopping around in intraday price action. Now, again, Just want to talk about the shorter time frame. So 5 waves to the downside. This is the 4-hour chart, so an intraday time frame. We've posted what's called a DMARC 13 count on that time frame. Now a DMARC 13 count often indicates the end of a trend, or at least an upward bias. Now we've got a 261.8% fib here at 112.33. To the upside, resistance going into this week is located at 112.70. So at the moment we've got a trend of lower lows and lower highs. So really we should still be looking at selling into rallies in euro dollar, at least at the beginning of next week. Going on to cable, let's break down a big picture analysis here. This still looks like a wedge formation. This is a monthly chart. We posted in there a bullish outside candle going back into January of this year. That often indicates the end of a trend. However, we are getting pretty close towards the base of that candle, which would then negate that trigger. If we go to this time frame, I mean, this is a really important time frame for cable, and especially when we're thinking about the correlation between sterling and euro sterling. Okay, so if we were expecting euro sterling to go to the downside, then we're expecting weaker euro and stronger sterling. So has cable got towards that level? Well, let's have a look at this time frame. This is the daily time frame. There's a few factors here that would lead us to believe that we're possibly bottoming out in cable. We've got some bullish divergence. So bullish divergence happens when the oscillator, and in this case it's the relative strength index, when that makes higher highs and the chart makes lower lows, it shows that the strength of these sell-offs are weakening, and there's a possibility of a turnaround. So that's the first factor. The second factor is the DMARC 13 count, and that was posted this day, 14th of June. Now, Peel recommends a stop if you're trading DMARC 13 counts of basically the lowest candle in that 13 count projected from the low of that lowest candle. Sounds complicated, it's not really. We'll probably do a video, educational video on how to calculate those at a later date, but I've calculated it, and the DMARC stop for that 13 count is located at 124.80. Now on Friday of last week, we made a low of 124.81. So that stop, extremely close as it is still in place as far as this DMARC 13 count, bullish count, is concerned. Now, if I go to this time frame, and this is again the intraday time frame, it's lining up really well with fib levels. Wave 1, wave 2, 3 and 4 close to the 161.8%, and then down here we've got the 261.8% fib level. We've seen an inverted hammer on the intraday chart. That's often an indication that the sell-off is coming to an end and we're getting the start of a new upward bias. Again, we've got lower lows and lower highs. This is a really big level for us at the beginning of next week, and that's 125.90. Perhaps see a rejection there, maybe a reverse head and shoulders forming, but at the moment we've really got to see a break, and a solid break of that level to reverse the bias in cable. So the signals that we're coming towards the end of a trend, but lower lows, lower highs, that needs to be reversed, and we need to see higher highs and higher lows really for the medium term bias to flip to the upside. Dollar Swiss, and this is really quite an interesting pair going into this week, and I've been looking at the crosses Euro Swiss and Sterling Swiss to try and work out whether or not they're coming to the end of their sell-off. Now, Sterling Swiss is quite an interesting currency pair. If we can analyze Euro Sterling properly, then it's normally -1 correlated to Sterling Swiss. So if we're looking at lower levels in Euro Sterling, then we should be looking at higher levels in Sterling Swiss. So possibly higher levels in Dollar Swiss. So moving away from that negative dollar bias perhaps for the Swiss franc. So let's have a look at a few time frames. This is the weekly time frame, broke this wedge formation to the downside. Important level 99. It's going to be a little bit higher next week, around about the big figure, which has attracted buying and selling. It's quite pivotal in dollar Swiss, one big figure, and it's an area that we should be aware of. So 1004 is the reverse trendline resistance of this wedge breakout. It's got a measure move down, target down here, but the intraday chart or the shorter time frames are sort of negating this wedge breakout, and let's just explain why. Okay, so this is the daily chart. This looks like an expanding wedge formation. Now, this in turn has a bias to break to the upside. So we've got that weekly wedge that says we should go lower, and then we've got the daily wedge which says we should go higher. Now we've got a trend of lower highs at 99.38, a break of there, clear break of there, and the measure move target is all the way back up here at 102.25. So mixed signals on those two time frames. If we go to this time frame, and again, this looks really important as far as our analysis is concerned. 1, 2, 3, 4. Are we completing a fifth wave? So going back to DMARC again, we've got a 12 count there. So the scope for buying still at the beginning of next week, because normally a 13 count would highlight a trend correction or reversal. Bespoke resistance is located here, 99.53. We've got intraday support located at 98.59. Now that's quite important when I'm talking about weekly and intraday. Basically, as far as our indicators are concerned, it could break this level, but as long as it closes below that level at the end of the week, then that signal is deemed to be correct, or that resistance level is deemed to have held. If we look here, we've got a 261.8% fib level at 1.0009. Again, very close to that reverse trendline resistance, very close to that psychological one big figure. So there's quite a deep upside barrier in dollar Swiss, but at the moment we'd still look to buy into dips, and like I'm saying, our bespoke support is located down here. Dollar yen. Again, there's pretty mixed signals here, and that's what we're talking about, sort of moving away from the dollar potentially for a while. ABCD formation target was completed, so we've got 1, 2, 3, 4, 5 waves to the upside, a corrective pattern lower. There wasn't really anything in the way of a reversal candle at the base, but we have moved higher, close to that 61.8% fib, which is located at 107.60. If we go to this time frame, and this is the monthly chart, got a big triangle formation. We did break it to the downside. There's an important level. The reverse trendline resistance is located at 108.87. Got to take note of that. It could hold going into this week. But going on to this time frame, and this is the intraday time frame again. Have we formed or broken out of a reverse head and shoulders pattern? So left shoulder, head, right shoulder. We've got some bespoke support located at 108.08 at the beginning of next week. That's that reverse trendline resistance. Okay, so we're very close to it. So buying into the market at these current levels is probably unwise. We've also got a DMARC 13 count. So that again could highlight that we see at least a downside correction. If this formation plays out, then the measured move target is up here at 110.20. But again, these signals are pretty mixed. We've got DMARC telling us to sell. We've got the head and shoulders telling us to buy. So really, I think at the beginning of next week, at least, then dip buying for us is probably the opportunity, with the risk reward factor being ample for that measured move target of 110.20. Dollar CAD, two time frames going to look at here, not the intraday chart. This is the weekly chart, a very large expanding wedge formation. We posted a bearish outside candle here. That candle is often an indication that the upward trend is coming to an end, and we're going to see the start of a downward bias. Now, we had a period of consolidation, correction, posted that DMARC 13 count again. We've seen an aggressive push to the downside. Now, the weekly chart did post a doji style candle, so that highlights indecision. However, there's nothing really in the way of reversal formations to suggest that the long-term bias is still not to the downside. And in fact, if we look at this formation, that looks like an expanding wedge formation again. So that's got a bias, long-term bias, to break to the downside. Shorter time frames. This is the one that I really like. This is the daily chart. This is a great level. So we've got impulsive move, then this corrective move to the upside. We broke the wedge formation. We've hit the measured move target. Friday, we've seen what was support now becomes resistance. That's been retested close to this 161.8% fib level. Now the reason why I said I like this time frame is I've got this confluence area down here. So this is a 161.8% extension of this downward move. And this is a 261.8% extension of this downward move. So we've got a confluence area to focus on for dollar CAD. Now, this move to the upside, although we have seen an immediate rejection, these corrective waves, if it is a fourth wave correction, is normally seen in a free wave pattern. So we've got resistance located at 131.55, and that's just above Friday's peak. Now, if we're going to move up to that level, it'll also be wise to look at maybe 4-hour time frames, see if we're seeing some bearish divergence. So in other words, the chart is making that higher high, but the oscillator is making that lower high, and that might mean that that move to the top to the upside again is just merely corrective. Aussie dollar. Let's look at a few time frames here. Weekly chart. We've got bearish Elliott wave count to the downside, pretty mixed and volatile trading here. Looks to be forming an an expanding wedge formation. Quite interesting here in the fact that the trend of lower highs is very close, this very deep Ishimoku cloud. So this upside barrier is probably going to hold at least for the time being, and that's located at 70.87. If we go to this time frame, and again the Ishimoku cloud on Thursday, levels outside of that cloud formation found some selling interest. The strong selling pressure on Friday has left a Marubozu level at 69.99. Now a Marubozu level is the open and the close, or the midpoint of the open and the close of a strongly bearish or strongly bullish candle. So that's quite an important level when we look at the intraday chart. Are we forming a reverse head and shoulders pattern? So this is the impulse move to the upside, possibly a fifth wave extension, not sure about that. We did post a DMARC 13 count on an intraday chart. We've moved to the downside. Now, the reason why I said that Marubozu level was quite important is because we've got some bespoke resistance located at 70 the figure going in to Monday. So Marubozu level at 69.99. Got a bespoke resistance level located at 70 the figure. So we like to spot these confluence areas, the more indicators or trendline resistance, etc., that we see at an area or at a specific price obviously strengthens that zone. But to the downside, we've got bespoke support here at 69.35. So we're basically trading in the middle. So again, talking about the dollar this week, for dollar-based currency pairs, we're probably going to be looking at selling rallies, buying dips, etc. And here we could be doing either. Euro sterling, like I said, this is looking quite interesting as a cross currency. 5 waves to the upside. Is this an ABC free wave correction completed? Bullish outside candle posted in May often indicates the end of a trend and the start of a new upward bias, but we've got trendline resistance located at 90.22 of this triangle formation. If we go to this time frame, and this is the daily chart, bullish count to the upside, strong impulsive move will normally mean that the next move is corrective. We've got a 261.8% extension level located up here at 91.28. But the more important factor, I think, is what's happening here. We've got some bearish divergence. So again, the chart makes higher highs. The oscillator, in this case, is the RSI, Relative Strength Index, has made lower highs. That's often an indication that the trend is coming to an end. We've got a DMARC 13 count here again. That's got a projected stop loss at 90.10. If we go to this time frame, and this is the intraday time frame, looks to be forming an expanding wedge pattern, a break of 89.26. It's going to be slightly higher, obviously, going into this week, 89.28, and the measured move target is down here at 88.26. So sort of swaying towards a negative or a bearish bias now, as opposed to that quite long-term bullish bias that we saw, at least for the short term. Euro sterling. There's not really much to say in this currency pair at the moment. Finding it quite hard to analyse, to be perfectly honest. We've seen quite an aggressive move to the upside. Last 2 days of last week, little net movement really. The Marabuzo level from this candle got close, and we have seen a rejection of intraday rallies. Now we've got a DMARC 12 count, so we haven't seen a 13 count yet. Is this, I'm just wondering whether or not this 78.6% fib level located at 120.68 is going to find some buying interest. But really at the moment, we're in no man's land as far as euro yen's concerned. And I think intraday, just because we've had that strong impulsive move to the downside, we should be looking at selling it into rallies. Now, I did say at the start, I'd like to look at two cross currencies. Only going to sort of briefly highlight what I'm seeing here. Aussie yen. This is the 8-hour chart. We've seen quite a bullish count to the upside, or a bullish move to the upside. Is this 5 waves completed already? So 1, 2, 3, 4, 5. Or is this 1, 2, and we're in 3, 4, and then going up in the 5th wave? The reason I quite like this analytical outlook for next week is that I've got some bespoke resistance located here at 76.48. I'm close to a DMARC 13 count. I think if we move up to that level, we're likely to see some bearish divergence in shorter time frames, 8-hour, 4-hour charts. If that is the case, we complete this 13 count, then I think we'll get a correction to the downside. Not a long-term correction. I think we'll probably form a head and shoulders pattern. So this would then be the left shoulder, head, the move up, completing the neckline, and then move down to form a right shoulder. But for me, I'm personally looking at that level. 76.47 is the exact level, possibly selling into rallies next week. And the next one I want to look at, this is Euro New Zealand dollar. So euro against the New Zealand dollar. 5 wave count to the downside. Bit disjointed. 1, 2, 3, 4, going down in 5. Are we now completing an A, B, C, D correction to the upside? So we've got a 38.2% fib level located at 69.91. Now I've got some bespoke resistance located at 169.93. Although we have seen a move lower off the high trade from Friday, I haven't got an exhaustion count. We've got a 12 count on the intraday chart. So I believe there's still scope for a potential push higher before we see a move again to the downside. Now, this again could potentially just be a short-term signal. And we could, if we broke down another time frame, let's just move it down to a 3-hour chart so we see sort of the intraday outlook a bit better. This could then form a bullish reverse head and shoulders pattern. So it would come down, left shoulder, head, right shoulder. So again, even though the bias is to sell into intraday rallies, that downside move potentially, if we get it, is likely, I think, to be limited next week. Okay, I hope you've found that analysis interesting, educational. We'll be back again with some more. We hope you have a good trading week, and we'll speak to you again soon. Many thanks.